Hi, everyone. Greg Towner here with Parallel Portfolios, and it is time for our November 5 charts in 5 minutes. So let's get right into it. Of course, we like to start off taking a look at the broader stock market. This is the S&P 500 over the last 3 years. We're really going to kind of focus in here on the last year. We, of course, have been in a downtrend, as probably all of you know, and we've been rallying here in the last few weeks. But we're now approaching this downtrend line that we've drawn, which also coincides approximately with the 200-day moving average. So it would be a natural area to meet some resistance in this rally. So that gives us a little bit of concern. So it is a kind of a textbook look at what would be a resistance point. The problem is, the one caveat I should say, is that a lot of people are looking at this now, and sometimes the market tends to surprise. So we're going to keep an eye on this. We are still in a good seasonal period. We've talked about some of the good stock performance after midterm elections. So there's a chance that we could blow through this resistance and kind of confuse people a little more. But until proven otherwise, we're going to say we're within this downtrend for the time being. Well, stocks aren't the only thing that have had a big move in the last month or so. This is a 10-year look, or no, excuse me, this is a 1-year look at the 10-year note, the bond yields. So yields had been going up all year, but just here in the last month or so, they've kind of rolled over. So that's given some relief. That's helped stocks. It's helped a lot of other asset classes. Maybe on the margin, it will help the housing market pick back up. Probably needs to come down further for that. But we've finally seen rates peak out, at least for now. So why is it that stocks and bond yields have made such a big move of late? Well, inflation is probably the thing that we've all been talking about a lot lately. We actually squeezing in a couple of charts on this page here, telling the same story though, really. We're looking at the US Consumer Price Index on the left, still high. This is a 10-year chart, but we can see it's coming down. We had another good print there last month, came in lower than expectations. On the right, we're looking at the Producer Price Index. Again, still an absolute high number, but coming in lower than recent expectations, trending in the right direction. You've been hearing us for months now. It's talking about the inflation data coming in, looking like it's softening. It just takes a little while for it to get reflected. Now, probably one of the most important areas of inflation is shelter. It's a big factor in the inflation data. We're looking at rental prices here. You can see that they're really starting to roll over. They're still increasing rents, but at a much lower rate of increase right now. Now, the problem is the shelter expenses, particularly rent, take a long time to factor into the CPI and the general government data. So it could be many months before this is really reflected. But ultimately, if this continues, this is really going to affect positively in inflation, meaning the inflation should be coming down some more. Well, that's the good news for the Fed, right? Because they're looking at a couple of key things. They're looking at wanting inflation to come down, but they're also looking at the jobs market. Now, this is a very long-term chart, multiple decades of the U.S. unemployment rate. You can see that we're still down here near all-time lows. So that's great for people with their jobs. It's great for the economy. As long as people have jobs, they're going to spend, and the U.S. consumer is always proves that. But the problem is, from the Fed's perspective at least, is when people are spending, that is going to put upward pressure on inflation. So oddly enough, the Fed wants to see this unemployment rate go up, and it hasn't been doing that. Sure, we're anecdotally seeing more and more announcements of companies laying off people in small groups, mostly on the tech side, but a little bit more. So you will probably see this number tick up a little bit here in the near future. But by and large, unless this comes up a fair amount, inflation is probably going to stay at a higher rate than historically normal. And that's one thing that we've been talking about is we do see inflation coming down, but ultimately wherever it settles, it's hard to predict, what rate that will be and when that will be. But we do think it will be at a little bit higher rate than it had historically had been. So hopefully the Fed gets comfortable with that and companies and individuals are able to kind of settle in on that. So let's just kind of wrap things up here in closing. I mean, we do think that stocks could be reaching a natural resistance point in this rally that it's had, but can't make assumptions. Keep open-minded. It's a good seasonal period, good record of returns after midterm elections. Markets love to surprise in either direction. So we'll be keeping an eye out for that. And of course, everybody's eyes are on inflation and the job market right now. The Fed is definitely focusing on those two. So we'll be watching to see how the next data comes in. We hope everybody has a great Thanksgiving, and we'll talk with you soon. Thank you.